that's when I transitioned from going from correction mode to full out bull mode. Instead of buying just the Qs, I ended up buying GBTC. As of today, like I'm triple digits gaining on both competitions. I guess bucket listing, I'd love to win it at least once. I think my biggest motivator is really proving myself. You'll see that many of your markets have begun in March. I think that we could see we could see a correction here over the next few months.
What is going on, everyone? This is Andrew O'Connell with Pristine Capital, joining us today to talk about his 2024 U.S. Investing Championship run. We have John Rodrigues, aka the Corky Investor, on Twitter. John put up a triple-digit year in the 2023 contest, and he's already off to a great start so far for 2024. How's it going today, John?
Hey, Andrew. Good morning. Thank you for having me. It's going pretty well.
Let's get started. We're going to talk a little bit about your background in trading, how you got started with the contest, what drew you to it.
Sure. I started trading probably a good 25 years ago. I've always been interested in it since I was a kid. It was something that always fascinated me, I guess, the stock market. And back in the day, you're probably too young to remember, but maybe if you see old clips of the New York Stock Exchange. Actually, I was watching Wall Street yesterday with my kids. And, they were just astonished at all the people that were on the floor and all the paper that were on the floor. So, and it's like that. And I think that always fascinated me and got me started with like the stock market and kind of learning my way through. I started off in operations and actually I still work now in operations. I've done like a full circle, but supporting investment staffs. And that helped me tremendously in like learning the markets, the different markets, not just the stock market, like the bond markets, the commodities markets, the foreign exchange markets. Those things are, the things that kind of revolve around the stock market. For us, they revolve around the stock market. In reality, they probably drive the stock market, to be honest. Mm-hmm. But doing that type of investment and support and research like that really got me, that really piqued my curiosity. Obviously, like in the 90s, the stock market was the thing to do. Everybody was investing, and then they weren't really investing, they were trading. And everything, you could just throw a dart and it was going to go up, right? So like that was the big attraction back in the day. But what really helped me was working in as a bond researcher, credit analyst, and learning how the different other markets work and how that could impact not only like the economy and eventually the stock market. So to me, that was like a really big aha moment. And it's at that point in the probably late 90s, early 2000s, where I started developing my own financial market models and economic models. And those have evolved throughout the years, because there's always different indicators, and sometimes ones work better in a different type of economic or background than others. So it's that experience and that knowledge and the growth of that knowledge has really helped me into becoming the type of trader that I am today.
Yeah, that's pretty awesome. So you got your start as a credit analyst. And so talk to me a little bit about your trading style. I know you mentioned in our last conversation you have economic models that you've built, but you're also doing some technical trading as well. So are you doing more trend following, mean reversion? What is your style looking like these days?
I think it's both. And before, like I would do a lot more trading based on the value based investing. So, the Warren Buffett way, and that's, like how I really got kind of like cut my teeth like in the industry, I guess, and learning the fundamentals. And that went well with being a credit analyst, because you're deep into like the financial statements, right? Like you're reading into that, you're looking at the balance sheet, correlating that with income statement and financial flows and so on. It's all that kind of meshes together. But eventually, at some point, I guess probably in 2004 or 2005, I read How to Make Money in Stocks. And that was a big changer for me. And it was a big time saver for me, because in a way they do a lot of the analytics already, not only for like the technical purposes. So you have your relative strength line, obviously, and stuff, but your EPS score and like just scoring the overall strength of the balance sheet and of the financial statements for a company. That's really helpful, because that kind of cuts down my work. I mean, I still look at it, but not like I just make sure that what I'm looking at is right and is right and it correlates well with the score they're having. But for the most part, like once I started applying like the can slim type of strategy and looking at charts in the way that's presented to you in that book, things really started changing for me. Like you as a value investor, you really have to be patient, and you're not really timing it, right? You're just basing it on value. So like, oh man, this stock looks cheap. So you start investing money. You're not really looking at, like Warren Buffett even says himself, he's not really looking always at where we are in the economy. He's just looking for good deals. So I don't really trade that way. Like I think it's important to look at where we are in the economy and balance that off with the strength of certain companies that could really benefit from a strong economy. So that's how I apply my strategy as far as like investing, and it's kind of become it's not only an investing strategy, it's become also my trading strategy, right? Like it's just they're commingled now. They're to me they're not two separate things. They're two very related things.
Yeah, that makes sense. And I think a lot of fundamentally based investors, the pitfall that they run into, and I've certainly fallen into this in the past as well, is you think that the stock market and the economy are the same thing and they're going to be moving in lockstep. So it's interesting that you have your economic models and that whole process, but then you're also looking at the price action, which is essentially what the other market participants are thinking and doing. So it sounds like you have a really blended approach.
Yeah, I would agree with that. Just to be clear, like the economic models are more for like a secular trend than they are for a cyclical trend. So like if like in 2007, by 2006, man, you could tell by some of like the spreads, you could tell by the CDS like swap spreads, like on some of like the mortgage backed stuff. Something was like not right. So by
Mhm.
2006 into 2007, like, we got into an inverted yield curve there for a few months also. But there were so many signs, the TED spread, which nobody talks about anymore because LIBOR is going away. But even that was like just going through the roof. Like there were so many things that were telling you, man, something's wrong. Like there's stress in the economy, there's stress with the markets and the credit markets. And like I mentioned earlier, like that's really what leads stocks. If you don't have like a healthy credit markets, even commodity markets, and so on, you're not going to have a healthy stock market. So to me, those were like secular trends that were showing stress. The economic models were telling me that there was stress in the economy with different markets as early as 2006, probably even before that. But I can't trade on that, right? Because if I start trading on that, I'm going to lose a lot of money. I have to wait for everybody to catch up with what I'm seeing and kind of like be prepared for that. So it allows me to kind of give me an opportunity to assess things and kind of prepare for what might be coming over the next few months to a few years. So a good example of that and how my models work. I think like in definitely late November, a lot of economists, a lot of forecasters and pundits, like they were putting a 60% chance of a rate decrease by May of this year. And I posted on Twitter, like, I don't even see a rate cut coming in 2024, much less by May. And that's just based on what I'm seeing on the indices that I've generated, the results that I've generated based on my economic models. Like I didn't see that, but I'm going to trade off the fact that everybody thinks that we're going to have a rate cut. I can't help that. So, in October of last year, I got pretty aggressive going into November. And that's just because of like the anticipation that we were going to get rate cuts in the first half of this year.
It makes a lot of sense. So you have your own view that you're generating based off of your process. And then you
Right.
also have a sense of what the market's view is. And if the market's completely disagreeing, you're not just going to
I'm
step
not
out in
fighting
front of that
that.
freight train. Yeah. So let's talk about, we know you crushed it in 2023. That was some phenomenal performance that you had in multiple divisions. I
Yep.
know you're competing again in 2024. How's it going so far for you in 2024?
This year, I'm off to like a phenomenal start, way ahead of last year. Last year I was hurt by the fact that I got off to a really slow start. So it was kind of
Mhm.
difficult for me to it took me a few months to get back into the black, and I didn't do so until like May. It was and that was because of my exposure to Nvidia at the time. I had Meta at the time, and I had options on both as we headed into May of last year, and that kind of helped me with the results this year. But with last year, I should say. But this year, I'm off to a really strong start. As of today, like I'm triple digits gaining on both competitions. So
Wow.
I hope to continue with that, with that performance. But and this year, really, like I was off to a good start. I had bought some companies early last year that or late last year in November that really helped me along the way. They didn't start really performing until like really late December and into January, and it just got me off to a really good start for this year. And then at the end of the month, the big driver this year was SMCI, right? So it's hard to not have triple digit results if you if you don't have SMCI in your portfolio, basically. But that was like that was the big catapult for me and the big driver this year of my results thus far. And I didn't have it right away, and I didn't buy it on 122 or 119 when it broke out here. Like this would have
Mhm.
been I just didn't have it then, and I didn't buy it here. But this would be my perfect setup. So usually the way I look at screens or charts are, I'll have a 50-day line, I have 200-day line, and that relationship to me is really important. This performance here is really important. The fact that the stock is able to maintain itself, and it's creating just like this flat base over since June, July of last year. A part of like what I'm looking at right now, like it's a really important part of the criteria that I look for when I'm looking for a good stock, right? So SMCI, I'm very familiar with it. I was familiar with it coming into this year. I actually had bought it right around here last year, and I wrote it up, and something was making me nervous about the market. I sold it out in July. So last year, my performance was really helped by the fact that I was able to sell a lot of my gainers right before we started that correction in early August. And that's what happened here with SMCI. And it was like choppy trading. It kind of made me nervous. And I ended up selling it. I actually thought I think I bought it here and then kind of wrote it all the way up here and ended up selling it because I wasn't really comfortable with this choppy trading. And plus, I just felt like my models were telling me the market was getting really toppy. Fast forward to this year, I had sold it. I didn't have the position. I started going long in stocks right around October, end of October into November. I started like selling all the shorts and the inverted ETFs that I have and started buying some of my favorite stocks. SMCI was not one of them at the time. Obviously, what got my attention and everybody's attention was when it broke out on 119. I believe that's the day that they pre-announced, and I still didn't buy the stock that day, even though like this is the criteria that I really like look at, and this is like the one I want to pounce on. I didn't. That's because all my other stocks and options, they were doing phenomenally well too. But at some point, like in these couple of days, I started thinking about it, and I knew they were going to report earnings either later that week or early the following week. And I analyzed their release, which really didn't say that much, but I if it had this type of reaction for the pre-release of earnings, pre-announcement of earnings, and I started looking at it, and I just went in. I just I felt like whatever they were going to announce during their earnings call, or their earnings results was going to be really, really strong. And they were going to share a lot more during that call. And that's exactly what I did. I bought call options heading into the earnings. I bought as much of the stock as I could. It started taking off. It started doing what I was expecting it to do. Well, I shouldn't say what I was expecting. I wasn't expecting it to double in like a few weeks, but it more than surpassed what my expectations were of the stock. So like I still own it. I've trimmed it over the last week or so, last couple of weeks, just for the fact that I want to raise money as I start looking for ways to reinvest that into maybe short positions, maybe inverted ETFs. And not that really, I think that it's going to be like a huge downward correction, although there might be. I have no idea what the deepness of it could be, but I do feel like there's going to be a correction. I just want to protect my portfolio for that reason. But SMCI was the big one. I also did not own NVIDIA going into January, and that was the same thing, right? So this is when I bought NVIDIA. That was the other thing, right?
Mm.
NVIDIA was taking off, broke out on big volume. That's what I look at. To me, all the signs were there that the stock was obviously going to do really well, and that in correlation with the pre-release of SMCI really got me comfortable in taking large positions in both NVIDIA and SMCI, both with stock and options. For each one of the competitions. So like these were the big drivers of for me over the last few months. The other big driver that's really helped me has been I bought GBTC in early November, I guess. Maybe actually it was like late October also. So like that period of time from October to November it was a really important period of time because that's when I transitioned from going from correction mode to full out bull mode, and I just got out on the 24th. October 24th, I got out of all my inverted ETFs. I was made sure all my put options were closed, and I made sure that all my I bought back anything that I had shorted, and I started buying the stocks that I liked. And at the time when things are breaking out, you're not really all that familiar with there's not other stocks that are really not all the stocks are breaking out yet. You just know that to me, we were just getting close to a bottom. We're starting to take off. But right here, as things happen in late October into early November, now stocks aren't meeting my criteria, right? Like they're not breaking out on big volume. Like they're going to go into recovery mode unless you're like one of the big leaders, and you could get it at the bottom of a range. Then I'll buy that stock. But what I do here for the most part is, yeah, there might be a handful of stocks that I really like and that I want to buy, but with the rest of the money, I allocate it towards ETFs. So I'll buy 3 times the ETF on, I don't know, the Spider or even the Qs, 2-time ETFs. And I do it based on the percentage of assets so that I don't overexpose myself. And then I'll just buy the ETF if I still have money after buying those, and I buy stocks that I like, and I'll just buy the regular Spider ETF, just to have a long position in the market. What happened this year in October was I really liked the trend that Bitcoin was going on and GBTC, and so I started putting my positions or buying the ETFs that I was buying was GBTC. So along with my triple leveraged Qs, my double leveraged Qs, instead of buying just the Qs, I ended up buying GBTC. So back in late October, we one of the things I look at, I don't know if you've caught it, Andrew, like is the my ETF momentum, which is another proprietary type of indicator that I use where I follow about 80 ETFs. And I'm just looking for strength and weakness in ETF. So I do the top 5 based on momentum, and then the bottom 5 based on momentum. And GBTC was just on it. The market was going down, but Bitcoin was actually doing well. It was trending upward, and I just didn't get into it earlier because I didn't want to sell yet the inverted ETFs that I had. So it was just a decision not to go into it right away. But it was definitely on my radar, and it was something I wanted to do as soon as I felt that we were about to kind of go back into rally mode, and that's what happened. So, like I said, October 27th, I sold all my short positions, put positions, and I just started going long. And I had a list of stocks. I bought the stocks that I wanted, but I still had a lot of money to put to work. So I ended up buying GBTC. And at the time, this was still like the whole speculation of the whole ETF for Bitcoin speculation and all that. And GBTC was really the only option we had, or that I had. Mm-hmm. So this is 10/24. This is when I started buying GBTC. So I took that position. It was a pretty large position in my portfolios at the time. And I still own a lot of GBTC, but I've trimmed it a lot, well over 50%. And like the whole purpose of me having like the inverted ETFs and some of the other. It's just so that when I sell them now, I have like a nice amount of cash that I could put to work, and I'm probably going to have about 20 or 30% more than I would have if I just had it in cash during that time of the correction. That makes a huge difference, right? Like in your performance, because now you have a lot more money to put to work. So GBTC, like I try not to get emotional with as we all do, I'm sure, with stocks and when they're going up and so on. But the whole purpose of buying those ETFs on the way up, so the long ETFs, and again, the levered ETFs and even the regular ETFs, is so that it could grow as you start identifying stocks that you want to get into. So as we're going up, like I bought these in the low 20s. As we're getting into 36 into 40s, like I'm selling these, I'm selling parts of it so that I can buy stocks that I really like. And that's how my strategy works. So like I'm not always looking, I'm not going to force a trade just because I think we're going into rally mode. I'm going to look for stocks or if they're not already on my list, like stocks that I think that are breaking out, that are performing strong, that have great relative strength. And I usually look for things at least EPS over 80, EPS over relative strength over 80 through the IBD measurements. Preferably up in the 90s in both. And that's even stronger. So these are the securities that this is the security. This is the type of stuff that I'll buy. Only so that I can have more capital, so that when I find the right investment that I really want to hold, I'm selling these, and it's after a strong performance, and I just have more cash available to put to work.
Gotcha. So it sounds like you're tracking ETF momentum, and then you're also tracking individual stocks as well. And you're sort
Yeah,
of layering your process where you'll go from the ETFs into the stocks, vice versa, and
agreed.
you're
Yeah.
kind of flowing with it.
Yep, that's exactly what I'm doing. So it's like I don't want to. Wavy's not the right word because it could have other meanings but it's transitional. It's really a transitional way of investing. And even through the transitions and through the tough parts of the market, I still have stocks that I hold for years. So over the last couple of weeks, not in the accounts where I'm competing for USIC, but in personal accounts, like there's stocks there that I've owned since 2017, 2018 that I'm trimming or selling now. And that includes Nvidia, and some of those stocks I no longer have confidence in. So I'm actually selling it full out so that I can raise enough money, to try to buy inverted ETFs so I can protect the accounts in case they go, in case we have a deep correction here. So, and that's what I've been doing. So like one of those stocks that I sold out was Apple. I sold out of Tesla too. And I held those for a long time, since 2018. And then I bought more at the bottoms of 2020. So those are all stocks that I've held for. So yeah, I'm a positional trader, but I'm also trying to manage the accounts, even for tax purposes and so on. Like I'm putting those things in consideration as like I'm trading also, if they're taxable accounts. For USIC, it's a slightly different beast. I wouldn't say it's a completely different beast because the criteria of what I'm investing in is still there. And it's, I'm still trying to manage a little bit, like for tax purposes, for example, but I got burnt this year by Tesla, right? Like, luckily I had sold a big chunk of it last year, I think in July or so, or maybe a little bit later. But Tesla, I had a gain going into this year, and I didn't want to sell it because like I had bought it in February, so I figured I could hold on for 6 more weeks or whatever it was, and that came back to bite me in the butt big time. Like that did not work out well for me. So there are risks like that, and those are mistakes, right? I should have just sold it. I saw the weakness. Like no, like 9 out of 10 times, that's not going to happen. So it was unfortunate that it did happen there. But I also, that chart does not look good.
Yeah, and especially with the valuation of that one, how it's trading, really like a tech or AI company, but the core business is cars, and car companies trade at such lower valuations. So yeah, this one, when the momentum's gone, it's spooky.
Yeah, it's bad. So as we delve into Tesla here, so I was saying before this, it's just not good. So, and this was the big one here, and I let it go to the 50-day. once it got beyond here, I would have still sold at a profit, and then it wasn't. So, but this is a very negative just setup. This is more of a short than it is a long right now. In fact, since we brought it up, I should probably disclose that I haven't shorted. And so it went down on big volume. It tried to kind of come back, but really like the volume wasn't there as it came back up. Most of the days where it was up, volume was really low. It just didn't look right. So, and as it approached the 50-day line, we've already had this cross down of the 50 going below the 200-day. It was just becoming more and more evident that this was like a short stock than it was like a long stock. And it has nothing to do with fundamentals. It's all technical. So this just didn't look good at all.
Yeah, that makes sense. This one is looking ugly. And now there's a bunch of overhead supply here as well.
There's a bunch of overhead supply. The 50 days chasing you down. Pretty soon the 200-day will chase you down. So this stock has, to me, might get a little bit of support here, but so we might get a little bit of a bounce back. We're still looking at the 120s. So you still have a good, what is that, like 25%, 30% down on the stock. So, and even when we get here, then we have to see how it reacts. Can it bounce off? Where are we in the stock market? Is it going to have like the wind at its back, or is it going to be sailing into the wind? Like, there's a lot of things that have to be answered, but right now this does not look like a very palpable stock, to say the least. And this is my weekly setup, by the way. So I like to look at things with the 40-week line on here, and I use this a lot to determine whether I should hold on to stocks or not hold on to stocks. I probably, once it got here, again, I should have sold. I didn't. It's continued its downward movement, and we're down. We're getting close down to where I think it could go. If we have any downturn or continuation of a downturn in the market, like we're going to get down to the 120s.
Yeah, so as we start to look forward here, we have some stocks like Tesla breaking down. We've got Apple breaking down. Some of the other mega caps are doing a little bit better. We also have this Fed meeting that's coming up on the back of too hot inflation prints. So what are you seeing as we look forward into and maybe past that Fed meeting?
Fed meeting's coming up in March, right? I think whatever's going to happen, or coming up now, right? To me, it's less about the Fed meeting and more about what the technicals are showing. It's incredibly coincidental how things kind of line up close to the Fed meeting, close to, like a major event like that where there could be a market turn. But usually you have clues as to what's going to happen by looking at the technicals. It's the setup. So yeah, you could come out with the Fed. Like, I've already expressed, like, I don't see how we lower rates in 2024. It might happen, of course it could happen. I just don't see the reasons for it. There might be pressures for doing it, but like that is, especially now that forget the fact that my economic models are telling me that there's really not a reason to do this. We could see it by the GDP rates. We could see it by what's going on in. Have we ever really cut rates during a time where the markets are at all-time highs? It would, to me, it would just seem it would be a really strange decision to do that. But forget all that. Put that aside for a second and think about, if he doesn't do it in March, if he doesn't do it in May, when is the next opportunity to do it? Because now we're getting close into the election time, and we know that the Fed hates to do any sort of rate changes as we get close to the election. So I think that's within like 6 months. Are we really going to do anything like within 6 months of the election? I find a hard time believing that we would. So I'm more concerned about this. I'm more concerned about the fact that we hit new highs in March. So stock market almanac, Jeff Hirsch, the whole thing. Like, do I trade off of that? No, but I believe in seasonalities, and I believe that certain stock, there's definitely more susceptibility when we have highs in at certain times of the year. March is one of those months. I get really nervous when we hit new highs in March. Um, and it goes back not just to 2000, it goes back beyond that. If you look at the history of the markets, you'll see that many of bear markets have begun in March. And it's just a
Mm.
seasonality thing. It's just the way the markets work. It's hard to explain why, but there's something to like that stock market almanac and the things that they write about. I find those things fascinating. Jeffrey South always used to reference it, and I think he was one of the best strategists on Wall Street. And that's kind of like how what opened me up to it. But like I spent the time like in the late like to after the financial crisis, a lot of times studying the markets, and I went back like 100 years and just looking at the markets. I don't think we've ever had a bear market, for example, that have begun in May. For example, there's a seasonality to things. There's things that could happen during the calendar year that might have an impact on the rest of the year. So, long story short, for me is forget the rates and all that. To me, I'm more concerned about the fact that we're seeing a top in March. It just doesn't bode well for the market. It can mean something bigger. It could mean a deeper correction. I can see that coming. I think that my estimate for the S&P 500 last year at the end of last year for 2024, I think was around 5250. We're at 5150. I'm not changing it. Because you're seeing a lot of strategists coming out now, and they're like 5500, and it's I think that we could see we could see a correction here over the next few months, and that could last through the summer and into early fall. I don't know what the deepness of it will be, and I'm not sure, but definitely like there's some sort of my models are telling me at the very least we're very toppy here, and I think everybody's models are probably telling them that, but at the very least we're very, very top.
That's going to be interesting as we get into this Fed meeting and beyond. But yeah, just in terms of the contest itself, as we start to wrap up here, what are your goals for the contest? I know you've been doing this for a couple of years now. Is this just something you enjoy doing? I can tell you're super passionate about trading and investing, which is awesome. Is your goal like you're going to do this until you win the contest? Like, what is motivating you to just keep putting up these crazy numbers?
I think my biggest motivator is really proving myself and proving that I'm a top investor slash trader. I think that's the most important to me. I think it's fun for my kids to kind of see my name up there, and my oldest son is 16. His friends are really getting into like the stock market, which is really cool. I think there's like a new generation of kids that are really getting into like the stock market. I think we went through what I call the financial crisis kids, where they got deeply impacted by the markets and lost trust and faith in the economic system. And so like they actually refer to influencers to kind of like provide them with financial advice and so on. And there's nothing wrong with that as long as it works, I guess, but they're not doing it themselves, and they're like not really participating in certain programs and so on. And then like I'm seeing like these kids that are coming up. There's one kid in my son's soccer team, 16-year-old kid, goes to a school like I did, like in the Newark public school system here in New Jersey. But man, he loves the stock market. And he talks to me all the time about options. And he's talking about the SMCI. He was talking about the SMCI options back in June and July of last year. And he'll just send me a text every once in a while, like, "Oh, John, did you see this talk?" And I love that. I love that fact. And it's just not him. Like, there's another. He's in college. He just went to college, but he's a freshman in college. But him and his friend in high school, they actually started up a company where they do education classes for younger kids and for high schools, and they're teaching them about the different investment vehicles and the markets, and they're learning as they go along too, which I think is really, it's, to me, it's fascinating, and it's just and I'm really happy to see that more people are participating or wanting to learn more about investing. I think that's a big deal. I probably went out on a tangent here. Oh yeah, so back to the USIC question. So yeah, and you're right. I'm pretty competitive also. I think even if I won the USIC, I'd still continue to participate, probably in the foreseeable future. But I don't like to count my chickens before they're hatched there.
Yeah.
While the USIC was not in functioning. There were other competitions. There was a global competition, and I would participate in that. It wasn't annual; it was every couple of years they would do it, and it was like through this brokerage firm in Portugal called Diff. But they had different. They worked with different brokers throughout the world, and that's how they did it. And it was a really cool process. It was automated. You could see the results like as they were happening. And it's all things like to strive for, right? Like as I think that USI, to answer your question more directly, like I think the USIC's got a ton of growth potential, and I want to be there to be a part of that. I think there's ways not to take anything away from like how it's been run, because I think it's great and magnificent, and it gets people's juices going, and I credit it with allowing me to, like, I'm much more. There was like a period of time there where I wasn't keeping up with my models, where it was kind of more difficult as other things were asking for my attention, I guess, in life. But it was harder for me to, even on a weekly basis, to kind of look at stocks on the weekly basis, update my models on the weekly basis. So like there were times where I would go a few weeks without updating it, and then I had to go back and like updating all that, and like that wasn't really helpful because I wasn't staying on top of it. I wasn't, my finger wasn't on the pulse, right? And with the USIC, like just being able to compete in it, I'm much more motivated to go in and make sure everything's updated, make sure I have everything up to date, so that I could, sound halfway intelligent when I talk about this stuff. And that was another reason. That was one reason why I actually did the Twitter account at Quirky Investor, by the way. One of the reasons why I did that was so that I could share my thoughts on there. And again, it forces me to make sure my models are updated, and I'm up, up to par with what's going on, and my finger are on the pulse of the economy and the markets. So I like the USIC. Like I'm thankful for it because it's really allowed me to expand not my knowledge base, but even like doing the podcasts, talking to other people that love the market as much as I do. It's put me like in a circle where it's just much more enjoyable, like it's just it's fun. Like this is fun. But yeah, I winning the USIC is extremely difficult because you just never. I think Mark Minervini like said it in one of his interviews. Was, winning it is, you don't know if you're going to win it, right? Because you could be the best investor, but that doesn't matter because somebody out of the blue could come in, buy a stock, could buy Coinbase, could buy SMCI, and just have that margined out, and here we go. It's going to be tough for you to manage that. Like I don't really invest that way. I know like swing traders do, but like, I have I have portfolios, USIC portfolio, even the enhanced one has over 10 positions, and so does the other one. And like, to me, my thinking behind that, I think of it like as a train. One cart's going to always be pulling it. So like maybe one day, maybe it's not NVIDIA that's like driving the markets. Maybe it's Meta, and I have Meta. Like I feel like every day, like there's positive yardage, when I do that, and that's part of my strategy too. To me, anyone could get pretty lucky winning it. I'm not sure there's not skill. There's obviously skill, but the importance of doing it in multiple years is to show that you have the capacity and the ability to be consistent with your strong results year after year after year. Sean Ryan's a perfect example of that. I don't think he's ever won it, but man, the guy's up there top 5 every year, and that I have a lot more respect for that because it's tough. That's tough to do. It's kind of like the World Series of Poker, like you're not going to win it every year, but if you're in the final table or in the top 2 tables, almost every year you're getting close there. Like that makes you a really good poker player. You know what I'm saying? So yeah, it's really, it is important to win it. Like it's important that's one of my things. I guess bucket listing, I'd love to win it at least once, but I recognize that I think the important thing is, the respectable thing is being respected, is being able to have the consistent results year after year.
Yeah, that makes a ton of sense. And I think if you focus too much on trying to get the W, then that can be counterproductive as well, because I'm sure every single year there's a bunch of people that are really gunning to actually like win the contest. And maybe those people don't all end up on the leaderboard at the end of the year. So I think your approach of like, you're pacing yourself, you're thinking about it in multiple years, not just one single year. It's really impressive, and the results, they speak for themselves.
Yeah, thank you.
Yeah. So thank you so much for taking the time to chat with us today. Where can we find your work? I know you mentioned your Twitter handle. If you could mention that one more time, and anywhere else people can find you.
At Quirky Investor, and I have been, people have been reaching out and looking. So I think over time I'll start putting more things out there. But anything I do will be communicated through my Twitter handle. So more to come. But as of right now, like most of my work, all of my work really is going through at Quirky Investor.
Got it. We'll definitely give John a follow for sure. Incredibly underfollowed on Twitter. And once again, thank you so much, John. I really appreciate the time today.
Thank you so much, Andrew. I really appreciate you having me on.
Best of luck the rest of the year.
Thank you. You too. Take care.